The passage of this One Big Beautiful Bill Act is going to affect you, and you've had the weekend or however long it's been since its passing to try and make sense of exactly how this bill is going to affect you. I started working on a video that would try and summarize everything in the 870 pages of provisions, but it just got absolutely insane. So I'm going to focus on the specific tax implications that apply to most people, and there are some especially interesting nuggets for those of you who are approaching retirement or who are already retired. Now, the best way that I could think of to make sense of all of this was to draw this out on not the trusty whiteboard, but this time on a piece of paper. My daughter let me borrow her colored pencils for this one, so she deserves all of the credit here. Let's start with the tax rates themselves. Our current marginal tax rates were put in with the Tax Cuts and Jobs Act of President Trump's first term. These were set to expire at the end of 2025 and increase at 5 of the 7 marginal levels. However, this most recent bill made it so that the existing tax rates do not expire and are made permanent. There are going to be several parts of this bill that are going to be referred to as permanent. Others are not. Very few things in this world are truly permanent. What permanent means in the context of these bills is that the provisions are not set to expire at some future defined date. However, some future Congress can absolutely change the things that we will talk about. So here are the 2025 tax rates based on your taxable income ranges, which leads us to our real drawing. When you are trying to figure out taxes, you have your total income. This is all of your income over the year. We don't have a lot of time to define all of this, but there is earned income. This is like your salary or your wages. There is unearned income, like interest, dividends, pensions, and others. There is other income, which would include things like gifts, Social Security income, and other things. So from total income, there are some above-the-line deductions like traditional IRA contributions and health savings account or HSA contributions that you subtract off of your total income to give you your adjusted gross income. This is a significant stopping point because in the initial renditions of this bill, there were some pretty massive changes to HSA contribution limits, effectively doubling them, as well as allowing people who are on Medicare Part A only to contribute to HSAs without penalties, because right now, those with just Medicare Part A are not allowed to make HSA contributions. These changes that were in the bill would have had some major impacts on the flexibility of those with HSAs specific to your tax situation, as well as the potential Medicare IRMAA strategies that you had access to, which IRMAA are the additional Medicare Part B premium amounts that those who make over a certain amount get to pay. But these HSA adjustments did not make it into the final bill, and they were removed. There are some minor tweaks to HSA rules, but they aren't nearly as impactful as they could have been with the doubling of the contribution maximums and allowing folks to contribute when they had Part A only. But we have arrived at adjusted gross income. From here, you have 2 paths. The first is the standard deduction path, and then the second is the itemized deduction path. Let's go over the standard deduction path first. The standard deduction is the specified amount that just wipes out a chunk of your adjusted gross income so that it isn't taxed at all. Over here, our tax brackets start at the 10% bracket. Think of that standard deduction as sort of an extra tax bracket of 0%. The 2024 standard deduction for joint filers was $29,200, and it was set to go up to $30,000 in 2025, but it has now been increased to $31,500. For single filers, 2024 was $14,600, and it was set to go up to $15,000 in 2025, but it is now increased to $15,750 as a result of this bill. So of your adjusted gross income, anyone using the standard deduction method can now subtract a larger amount from your adjusted gross income, and that would be your starting point to send your taxable income through the marginal tax brackets. Another way to think of this is you just saw your 0% tax bracket expand a little bit. These higher standard deduction amounts were also made permanent. These standard deduction amounts were set to expire at the end of this year, but this bill made these new higher standard deductions permanent. Again, meaning that there isn't a defined year that they will go away, but again, a future Congress can still change them. If you are pre-65, that is your standard deduction picture. But if you are 65 or older, there is a whole lot more happening. You get additional amounts added to your standard deduction. For joint filers, it is $1,600 per person for a total of $3,200 for a couple. For a single filer, it is an additional $2,000, expanding that standard deduction for you. And this was happening before this bill. This isn't something new. This is just an additional deduction that goes on top of your standard deduction once you reach 65 years old. Now, President Trump has long discussed eliminating the taxation of your Social Security benefits. This is one of the more interesting parts of this bill. And look, people are going to want me to take sides on this. I'm not going to take sides. I'm going to show you how this works for most people. Remember, there are exceptions. First, this bill did not end the government taxing of your Social Security benefits. There is still a calculation that will determine how much of your Social Security income is considered taxable. It is the same equation that they have used with the same income thresholds for the past 40 years that have not been adjusted up for inflation over that time. And you can still have anywhere from 0% up to 85% of your Social Security income be considered taxable. We have several videos on this that you should watch to see how this is calculated, including downloading our Social Security Taxability Calculator for free. There is a link in the description of this video to that download and another video on how to use it. So again, Social Security is still looked at and potentially taxable depending on your income setup. However, this bill has introduced something called the senior bonus deduction that is supposed to counteract the tax on Social Security for what they say is 88% of recipients who are seniors. It is $6,000 per person who is 65 and older. And what makes this deduction unique is that you can apply it whether you take the standard deduction or you itemize your deductions. For those of you taking Social Security before 65, I'm sorry, but this isn't for you to use yet until you turn 65. So already we have some Social Security recipients who are pre-65 that are still feeling the full impact of the taxability part of Social Security. But for those of you who are 65 or older, let me show you how this bonus deduction is supposed to help counteract the Social Security tax situation. I'm actually going to use higher numbers here because it will affect higher income earners less than lower income earners. Let's say that you and your spouse are over 65 and you have $80,000 of income coming to you this year. Plus, you add on $60,000 of Social Security income for a total of $140,000 for the year. In this example, 85% of your Social Security income would be considered taxable income. This is $51,000. So the other $9,000 disappears from your taxable income, meaning that you show $131,000 of adjusted gross income instead of $140,000. From this, you subtract out the new standard deduction, showing about $96,300 as taxable income. Your total taxable here as a couple is around $11,100 because you included Social Security income. Had Social Security income not been taxed at all, like the promise was earlier, your total tax bill would have been around $5,000. But Social Security income remains taxable. And now, as a result of this bill, this couple has $12,000 in new senior bonus deductions to lower their taxable income to $84,300. We run that new number through our tax brackets and we still have a tax bill of about $9,600 instead of $11,100. So it didn't eliminate the effects of the Social Security tax in this example. It did reduce it, and the impacts will be more or less noticeable depending on your mix of Social Security income and other income. Now, there are a few important notes to this deduction. First, this bonus deduction phases out at $150,000 of income for joint filers and $75,000 for single filers. It is reduced by 6 cents per dollar over the limit and is gone at $250,000 or more in income for joint filers and $175,000 or more for single filers. Second, this is not a permanent part of the bill. It goes through 2028, so you have 4 years to take advantage of this deduction, and it allows for some interesting financial planning opportunities that I will share with you after we finish up this drawing, because we have one more new deduction for this standard deduction path, and that is for charitable giving. Those who are charitably inclined really only saw tax benefits for those contributions if you itemized your deductions. But starting in 2026, so not 2025, but next tax year, joint filers who use the standard deduction can now deduct up to $2,000 in charitable donations, and single filers can deduct up to $1,000 in charitable donations. And this is a permanent change. Now let's take a step back for a second and look at what this really means strictly from your experience with taxes if you use the standard deduction. First, Marginal tax rates do not go up in 2026 and are permanent at current 2025 levels. Second, the standard deductions are made permanent, and instead of the original $33,200 standard deduction for joint filers over 65, you now effectively have $46,700 as a standard deduction, plus another $2,000 if you donate that much or more to charitable organizations. Instead of the original $17,000 standard deduction for single filers over 65, you now effectively have $23,750 as a standard deduction, plus another $1,000 if you donate that much or more to charitable organizations. Again, higher income earners have phase-outs of these bonus deductions. After all of these deductions, you get down to your taxable income, which, if you don't have any other credits, gets run through your marginal tax brackets over here. Last thing on the standard deduction half of this picture, there is a different tax classification called head of household. I apologize for leaving you out. I just ran out of room and should have gotten a bigger paper, but your levels on a lot of these either match the single or are somewhere between joint and single rates. Okay, let's move to the changes for those of you who itemize your deductions, meaning you do not take the standard deduction because by itemizing your deductions, you may have even more tax savings than the standard deduction amounts. Just like before, we start with your total income, we subtract out the tax-advantaged accounts like IRA contributions or HSA contributions to get your adjusted gross income. There are others, but the three main deductions that those who itemize their deductions lean heavily on are first, state and local tax, often referred to as SALT. This was capped at $10,000, which for those of you in high tax states limited you quite a bit here. This has been raised to $40,000 for those whose modified adjusted gross income is less than $500,000. For incomes above $500,000, this amount phases out gradually until reducing itself back down to the $10,000 cap. This change is not permanent and it is set to end after 2029. So in 2030, it will go back down to the $10,000 cap unless a future Congress changes their mind. The second big deduction that those who itemize their deductions use is mortgage interest. This bill just made permanent things like the $750,000 mortgage interest deduction cap and the deductibility of mortgage insurance premiums, which had been temporary provisions prior to this bill. The third big deduction for those that itemize would be charitable contributions. Again, this did not change, and no, you don't get to add those charitable contribution amounts that we talked about in the standard deduction path onto this over here. Those are provisions that are just for the standard deduction path only. Charitable contribution deductions are the actual dollar amount that you contribute over on this itemized deduction side. So those three items used to be the three main deductions that people who itemized would lean on, but now we have two more relatively large ones. The first is car loan interest is now deductible with 5 important caveats. First, it is tied to your income, so higher income earners phase out of this. Second, the car must be assembled in the United States. Third, this is for new cars only, not for interest on used car purchases. Fourth, this applies to vehicles that are for personal use only. This is not for business vehicles. There are other changes to business tax situations that are not covered in this video. And finally, fifth, this is not permanent. It extends through 2028. So that's a new one. And the last new major deduction that those who itemize can use would be that senior bonus deduction of the $6,000 per person or $12,000 for the couple. After all of these deductions, you get down to your taxable income, which again, if you don't have any other credits, gets run through your marginal tax brackets here. One more important change I'd like to bring up before talking strategies with you, and that would be the estate gift tax exemption. This was set to expire after 2025 and return to pre-2018 levels, going from $13.99 million for an individual, we'll call that $14 million, back down to between $5 and $7 million, essentially getting cut in half. Instead, in 2026, it is being raised to $15 million for individuals and $30 million for couples. And while this isn't a big increase from 2025 levels, these levels are now being made permanent instead of the past where they were set to expire. Okay, allow me to wrap this up with some high-level strategy thoughts directly related to these tax changes for those of you who are approaching retirement or you are currently in retirement. Remember, a lot of this conversation, we had certain things that were permanent and certain things that are set to expire after 4 or 5 years. So in this 4 to 5 year window, you have a couple of opportunities to look at something like, first would be Roth conversions. If this is a strategy that you are considering, or maybe you are already actively using Roth conversions in your retirement strategy, if you are 65 or older, there is some newly added wiggle room for many of you with these new tax deductions. This does not mean that you should do Roth conversions. That's not what I'm saying, but it does mean that you could look at that strategy with a different lens because of these different tax parameters. The second strategy to consider is related to the first but different, and that is that these added deductions could provide you, again, with a little bit more wiggle room to coordinate your withdrawals from accounts like traditional IRAs to make your existing or your future required minimum distributions more manageable. Finally, with these tax changes, harvesting gains and resetting your cost basis for some of your appreciated assets that may be sitting in taxable brokerage accounts could be something to look at with your financial advisor or yourself if you are a DIYer. Now, a regular contributor to this channel, Zach Call, talks through a lot of these situations and how they work or worked before the big beautiful bill passed. And now watching those videos again can add even more insight for those who are interested in how all of this shakes out with your tax situation. All right, that was one tiny section of this massive bill, and it took this long. If you got value out of this, please consider subscribing to this channel. It helps more than you know, and share this video with that friend or that family member of yours that has been asking you about all of this stuff, or maybe they've been telling you about all of this stuff. I'm going to let the experts who are much smarter than me in the other areas of this bill, like defense and agriculture and everything else, tackle those parts of the bill. My partners and I are retirement nerds, so we geek out about things like Medicare, that's me, Social Security and financial planning, that's Zach, and estate planning, that's Jim. You can reach us at theretirementnerds.com if you would like our help. The secret code word for this video is cement. A lot of talk about permanent changes and others that expire or do not cement themselves forever. Now, I leave secret code words in most of my videos to help me manage the comments because I get a wide variety of pretty awful comments from people who don't watch the video and try to guess my political leaning, then call me all kinds of interesting names. So if you leave the word cement in the comments, then I'll know you've made it at least this far before calling out any of my mistakes that I may have made or trying to incorrectly guess my political thoughts. I sincerely appreciate you making it this far, and I recommend this video for you to watch next. I will see you over there.